Hey guys, welcome to another one of Wealth Street's elevating videos. Today we are going to be looking at index funds, ETFs, and mutual funds. They're all very similar investments, but still different enough that they have slightly different names. What you want to know is if any of these investments are so different that investing in one will have a significant benefit over the others. Which investment will have the greatest impact on your wealth in the future? That is the only reason you're investing in the first place. You want to build wealth, but if you're choosing the wrong investment type, then you may be causing yourself to lose hundreds of thousands of dollars in future gains and possibly even millions. So, which is the better investment? Before we actually choose a winner, though, I think it's going to be critical that you understand what each of these three investments are and what is unique about each of them. On a very basic level, all three of these are types of investment funds. An investment fund is a pool of money that multiple investors pay into. The collective capital of all these investors combined allows the fund to buy into a broad selection of stocks, bonds, and other assets. Investment funds basically allow you to add hundreds and even thousands of different stocks, bonds, and other types of assets into your portfolio without you having to actually go out and buy all of those assets individually. And it's honestly one of the best and easiest ways to invest your money and build your future fortune. Even Warren Buffett once said that the best way to invest your money is with a low-cost index fund. Before we go too far, please make sure to give this video a thumbs up, and if you are new to this channel, feel free to hit the subscribe button at any time and turn on the notification bell beside it. So now that you know what an investment fund actually is, let's start going over the individual types of investment funds, starting with ETFs or exchange-traded funds. It is a type of investment fund that actually trades on the stock market just like other stocks. A really easy way to think of an ETF is as a basket, and that basket can hold thousands of different assets including stocks, bonds, REITs, and sometimes even derivatives. For example, let's say you wanted to invest in the S&P 500 index. Well, you could technically go and buy all 500 stocks that make up that index. You would be spending tens of thousands of dollars buying each stock individually, or you could just buy a single share of an S&P 500 ETF and give your portfolio the same exact exposure for a fraction of the cost. And because ETFs trade on the stock market just like stocks, they are an ideal investment for somebody who's looking for liquidity and just overall flexibility with their investment. If you ever needed to sell your ETFs quickly as long as the stock market was open, you could hop on your computer or even your phone to execute a sell order and then quickly turn your ETFs into cash in not much time at all. Next are index funds. An index fund is essentially the same thing as an ETF, but the biggest difference between the two is that, unlike ETFs, which are bought and sold on the stock market, index funds are not. Instead, to invest in index funds, in most cases, you would have to open a brokerage account with the broker whose index funds you wish to invest in. For example, if you ever wanted to invest in, say, a Vanguard index fund, you will need to open up a brokerage account with Vanguard, and the same is true with Fidelity's index funds, Charles Schwab, and many more. Index funds invest primarily in stock market indexes, and there are thousands of different indexes in the US stock market alone. The three most popular indexes that you'll likely recognize include the S&P 500, Dow Jones Industrial Average, and the Nasdaq Composite. The goal of an index fund is to track the performance of a particular index as closely as possible. Let's say, for example, you invested in an S&P 500 index fund. If the S&P 500 index goes up 3% for that day, then your index fund will also be up to 3% in your value for that day. On the contrary, if the S&P 500 is down 5% on the day, then your index fund, which follows the performance of the S&P 500, will also be down 5% in value for that day. Finally, mutual funds. A mutual fund is almost like an index fund. In fact, you could technically say that an index fund is actually just a type of mutual fund, and while that is true, the two are still different. Mutual funds are almost always actively managed. This means that there's a management team or fund manager who controls the fund's day-to-day investing decisions. The goal of a mutual fund is to try and outperform the market. A fund manager will do their best to allocate the funds within the portfolio in a way to do exactly that. Whereas most index funds are passively managed, which means there is no fund manager moving investments around and making financial decisions for the fund. Instead, most index funds simply track a specific stock market index and then they try to match the performance of that index instead of trying to outperform it like with mutual funds. Honestly, from my own perspective, I don't see any situation where it makes more sense to invest in a mutual fund over a low-cost index fund or ETF. Mutual funds are much more expensive and they almost never actually beat the long-term returns of a passively managed fund such as an ETF or index fund. Mutual funds are actively managed, which means there's a fund manager who manages the day-to-day operations of that fund, and you better believe he's not doing it for free. In fact, he's actually getting paid really well and his salary is simply being pushed back to you in form of higher fees. The average cost of a mutual fund is about 82 cents, whereas the average cost of an index fund is around 9 cents and 4 cents for ETFs. For example, Fidelity actually offers ETFs that have a 0% expense ratio, meaning they are completely free to own and there are no hidden costs or fees. So of these three, which is actually the better investment? Where should you be putting your money? Well, there is no one-size-fits-all answer. I know that's not what you're looking for, but honestly, it really just depends on your investing goals and which of these investments will help you to achieve those goals more efficiently. It depends on how much control you want over your investing strategy and which of these investments will give you the most flexibility and liquidity. I would say if you're looking to completely automate your investing and never have to worry about touching your brokerage account ever, then go with the low-cost index, preferably from Vanguard. If you're somebody who is looking for just 100% flexibility and control over your investments, then I would say you should probably go with ETFs, because ETFs trades on the stock market just like stocks. ETFs will allow you to quickly buy and sell to make adjustments to your portfolio in just a matter of minutes. But as much as I don't like mutual funds because they're expensive and they almost never outperform low-cost index funds or ETFs, there are still people who really like them. If you just really enjoy the idea of a fund manager managing your money and you also enjoy paying more money to get less of a return, then yeah, go with the mutual fund. Ultimately, choosing which of these investments comes down to personal preference and your investment goal. You honestly cannot go wrong with putting your money into any of these three investments. As much as I have a biased opinion, even putting your money into a mutual fund is a million times better than just letting it sit on your bank account where it's generating close to nothing. It's actually losing value because of inflation. So if you can get started as soon as possible, invest regularly, and pick the right investment time that's going to give you a higher enough return over the years, then you will without a doubt retire a millionaire. It is inevitable. The math is there. You just have to be willing to make the sacrifices now. Treat investing as an actual expense. Like a bill, each month you're required to put away X amount of dollars into your brokerage account in order to take advantage of the compounding interest. And that, my friend, is where the magic happens. That's where a few $100 becomes millions in years. And that's it for this video, friends. I hope you enjoyed this video and got a lot of value from it. Make sure to give it a thumbs up and hit that subscribe button and turn on the notification bell beside it so you are the first one to see any new videos. Thanks for watching. Until next time, this is Wealth Street.